What's up, everyone? It's Scotty with MoneyVest. So today we are going to be talking about one stock that I do think has a ton of potential in the semiconductor sector, semiconductor industry, and we're going to run through the intrinsic value. It is somewhat close to the intrinsic value. I guess maybe not super close, but still does need like a 25, maybe a 30% drop. But it's certainly a stock that we can add to our watch list and potentially look forward to buying in the future if and when it actually trades down to some of my intrinsic values. So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. I would really appreciate that. And link to our Discord and Patreon is going to be down below if you're interested in joining. And I also do want to mention that we've got a brand new course, and that's going to be the psychology of investing, money, and markets. And this is, again, taken me a long time to build. It's got, over 25, 30 lectures. I still have to upload a few more, but you get lifetime access. And this is a course that I'm super proud of, and currently it is 50% off. Coupon code is going to be launch, and it's essentially a course that teaches you how to master your mind, master your psychology when it comes to investing and trading. It's a compilation of many years of investing experience, trading mistakes, avoiding costly mistakes, and of course, lessons from a lot of the most important books when it comes to finance, investing, trading, and business as well. So link's going to be down below if you want to join. Now we've got over 4 courses on fundamental analysis, technical analysis, options, and psychology. So everything is going to be currently 50% off on the back of Thanksgiving. So we're doing a Thanksgiving sale, and the coupon code is going to be Thanksgiving for individual and for bundle courses, 50 to 60% off that you can take advantage of with the link down below. So company we're talking about today is going to be Applied Materials, ticker symbol AMAT, in other words, AMAT. And this is a stock that did report earnings recently. They did beat on both EPS and revenue, got bought up fairly quickly, was down a little bit over 4% on Friday. But if you take a look at intraday, it actually rallied over 4.8, almost 5%. So very, very strong move to the upside for Applied Material. And again, they are a global company with deep expertise in materials engineering, providing manufacturing equipment, services, and software to the semiconductor display and other related industries as well. This right here is the phenomenal revenue growth is what we have seen from $9 billion to well over $26.5 billion for the company. So very nice consistent growth, as you can see from the histograms as well, and from $3.8 billion to well over 12.3, almost $12.4 billion in growth in gross profit as well. And operating income has also gone from $1.5 billion to well over $7.7 billion for the company as well. So very nice consistent growth in revenues, gross profit, and operating income as well. If you take a look at net income, so profitability on a bottom line basis from $1 billion to over $6.8 billion, it's almost a 7x growth here for the business in the last 9 to 10 years. Shares outstanding have also gone down, so it literally checks off a lot of the initial boxes, right? So we got growth in revenue, growth in earnings, share count going down, EBITDA moving in the right direction. This right here is going to be the margins, excellent margins at 46, 47%. We got 28% EBIT margins, 30% EBITDA margins, and net margins sitting at just under 26% with very good return on capital, common equity, and assets. In other words, the company is very efficient. And if you take a look at this, which is, how much they're making per employee, profit per employee, another really important metric, $179,000 on a 5-year basis to now $201,000. This is not $201 million, but $201,000 is what they are making on a per employee basis at the moment, which obviously has seen a significant increase based on their 5-year average as well. I don't know why it says $201 million, and it shows like 111 million% increase, and of course 112,000% increase, which is not correct. I think it should be $201,000 per employee is what they're making. This right here is going to be the balance sheet. So check off here as well, because there's 4 things I look for in a balance sheet: more cash than debt. The company checks that box, right? Almost $7 billion of cash with a little over $5.5 billion worth of debt. So we've got a negative net debt. That's exactly what we're looking for. Current ratio over 2.6, quick ratio over 1.6, and debt to free cash flow under 3, sitting at 2.5. So check marks across the board for balance sheet here. And this right here is the valuation. So we've got a company that has growing revenues, earnings, profitability, margins, very good, return on capital, assets, equity, so very strong efficiency. Balance sheet's phenomenal, and the valuation's quite reasonable here. We're looking at 18, 19 times earnings multiple with a little bit over 4.7, close to 5 times sales, and price to cash flow trading at 14 to 16 times. So it actually is quite good, in my opinion, for AMAT. And this right here is going to be the forecasted earnings. We're looking at mid double digits to somewhat high double digits to then moderating down to high singles in 2028. So going from $7.69 to over $13 over the long term. And this right here is the 12 months ending in 2023 is what the company reported. Again, an increase, a moderate increase in net sales, a little bit of an increase in operating in gross profit, and of course net income also increasing from 6.5 to 6.8 billion dollars, with EPS sitting at just over $8.11 for the company as well. This right here is going to be the balance sheet. Again, we've already gone over that, so we don't have to go over that again. And this right here is going to be some of the highlights. So record revenue in the fourth quarter and in fiscal year 2023, 17 consecutive quarters of year-over-year growth. So if you do the math, that's over 4 years worth of consistent year-over-year growth here for the business. And then finally, 13% revenue growth, 30% non-GAAP EPS growth. Over the last 10 years, the compounded annual growth rate for free cash flow is over 33%, with a 12% increase in quarterly dividend for the company as well. So here are some of my fair valuations for the business. Okay, so if we account for, let's say, $6.8 billion in actual net income, this is exactly what the company has done. So right here, this is the number that I'm taking, $6.85 billion, and we grow them at a 20% growth rate, right? 25 times price to earnings multiple, which is a little bit of an expansion from where we are, 12% discount rate and 10% margin of safety with a 2% share dilution. We're looking at $99.98 as the fair value or the intrinsic value for Applied Materials. And right now it's trading at about $148, which definitely is a little bit on the higher end for the company. So, if you come back over to the statistics, you'll notice 19 to 15 times earnings multiple. You know what? I'm actually going to do the analysis right now once again, because it doesn't quite make a lot of sense that I'm looking at a very high growth rate and a higher multiple, and yet the fair value is lower. So, okay. That's what it was. Yeah, see, that's why it was kind of messing it up, because earlier I had this calculation done already, and right now I need to fix that. So it will be, let's see, shares outstanding, market price, market cap, market price times shares outstanding. Okay, so this will be just this divided by that. And we're looking at 837. There we go. So 837 million shares outstanding. And if we go with, a modest 14% growth and a 20 times P multiple, there you go. Now we're looking at $178 intrinsic value. And this is based off of a 14% growth in net income and a 20 times P multiple. I was like, that doesn't make any sense. Like, I need to fix the shares outstanding. And that's probably what it was. So 837 million shares outstanding. And now if you do a 14% growth rate, which is obviously lower, and 20 times P multiple, which is going to be slightly higher than where it's trading at right now, $170, and at the moment it's at 142, so meaning 20% undervalued. One could argue that it's 20% undervalued right now, and this right here is going to be that sensitivity grid where you can take a look that, okay, based on 20 times multiple and a 14% growth rate, 178 is where we're at. If you drop this down to, let's say, 16 times multiple and a 12% growth rate, then we're looking at $130, which obviously is still not going to be that far off from where we're right now, 148. So if you drop down to, let's say, 12 and 16, we're looking at $130, a 12% growth in net income, 16 times multiple, which means about a two multiple compression here, and we're looking at only 12% downside needed in order for the stock to be trading at its intrinsic value. Now, if you come over to the discounted cash flow, let's say $5.57 billion, and we're looking at, let's say, a growth rate of 10, maybe 12%, and then a 12% discount rate, 3% terminal growth rate, 10% margin of safety, and 2% share dilution, we're looking at about $109 per share as the intrinsic value, meaning 27% more pullback needed in order for this stock to be trading at its fair value. Now, let's just up this number to 16, or let's say 18 here. Now we're only 7% overvalued. Let's do 20%, and there we go. Now it's literally dead center at $140. That means AMAT would need to grow their free cash flows by 20%, discounted back at 12% in order to justify today's valuation, which, if you take a look at the past, I mean, they have grown their actual free cash flows by 33% over the last 10 years. But just because that's happened in the last 10 years doesn't mean it's going to happen in the next 10 years. And that's why we have to go with somewhat conservative estimates moving forward. So yes, 20% may be possible, but is it the most realistic outcome? Maybe not, right? So we need to go a little bit lower, say 16 to 18%, and that's when the fair value drops down to 127. And this right here is also going to be closer to 130. So I would argue somewhere between 127, 130s is where Applied Materials is going to be appropriately priced. And this right here is the entire sort of technical analysis with a very strong support sitting at 129. This is exactly where we bounced off of, and it basically pushed up over 21, 22%. It would be a very, very strong support at those levels. And also from a fundamental standpoint, a very good sort of potential opportunity. And we also did have the 200 SMA sitting right there for Applied Materials. So there's a lot of different things, a lot of confluence suggesting 129 to 130 is going to be a very good level to watch for Applied Materials. So let me know your thoughts down in the comment section below for this company. And we do have a resistance sitting all the way up here, sitting at 159, 160, all the way up to as much as 153 as well. So those right there are going to be some of the levels to watch. But as always, if you enjoyed this video, find it helpful, make sure that you drop a like. Don't forget to subscribe. And also don't forget, we do have a lot of the courses 50% off. All of them are going to be 50% off. Coupon code is going to be Thanksgiving. And for the brand new one, the coupon code also that you can apply is going to be launch. Either way, 50% off with the Thanksgiving sale that we have going on. So link's going to be down below. As always, happy investing, and I will see you all in the next video.